Good morning. Welcome to 3 Minutes on Markets and Money. Yesterday, the market sold off because of the Fed talking about taper. Are they going to taper sooner, later, whenever? I doesn't know, but the market's so confused yesterday, wound up giving up much of the gains that we've seen over the last couple of days. Yesterday, in a fairly sharp decline, sold off about 1% heading into the close. Now, a couple of things happened here. Yesterday, we noted that we had triggered a money flow sell signal. Of course, that now has kind of aligned with this recent market peak in the markets as well. So again, kind of going through that normal correction process that we see with money flows. The issue now, of course, is can we hold the 50-day moving average? This morning, stocks are going to open a bit weaker here, and we're going to be looking to test that 50-day moving average. And that's really been kind of the line in the sand for stocks here over the course of the last several months, and has been a repeated process that the markets test this 50-day moving average. That's been the buy the dip opportunity at this point, and markets have continued to kind of stair-step their way higher. Retest the 50-day moving average, rally, flatline, test the 50-day moving average, rally, flatline, test the 50-day moving average. It's been this stair-step process the whole way. So the question is are we just going to keep doing that again? Most investors right now thinking that is probably going to be the case. I don't necessarily disagree with them because at the moment we still have $120 billion a month in QE. The Fed is not tapering just yet, but the risk is coming that they may start talking more and more about tapering, and could see that as soon as we get into September. So it's certainly something worth paying attention to. As we've said before, it's been a very, very long time since we've tested the 200-day moving average. That currently is about 10% from the previous highs. Again, not outside the realm of normality. A 10% correction in any given year, completely normal. More importantly, a test of the 200-day moving average in a given year is very normal. In fact, if this year is a year, 2021, that the market does not test the 200-day moving average, that will only be the 14th time since 1929 that's happened. So again, a test of the 200-day moving average in any given year, very normal from an odds perspective. So again, that's about a 10% correction from the peak. Could we be getting into that type of a scenario? Absolutely. Likely we're going to see a test of the 200-day moving average between now and the end of the year. I suspect that that would be after some type of announcement of either much weaker economic growth or the Fed actually talking about tapering. That's going to be really kind of the clues to be watching for here over the course of the next several weeks. One last thing to keep a watch on, of course, is Treasury yields. That has continued to find a base here and continue to hold up here. Likely we're going to see yields continue to decline, particularly as we begin to see economic growth weaken even further. Again, yields telling the story here about what's really happening in the economy. And of course, falling yields ultimately are going to impact the financial markets. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. We'll see you next time.